All right, let's get right into it. Welcome to this explainer, where we're going to unpack the absolute latest data from early 2026 to uncover exactly where true real estate profitability is hiding in Japan's rapidly shifting hospitality sector. Look, if you're an institutional fund manager, a real estate investor, or just someone tracking the mechanics of this massive tourism boom, you're gonna want to pay close attention. We are witnessing a fundamental rewiring of where tourists go, where they stay, and, most crucially for us, which properties are actually generating a meaningful yield.
Here's a quick look at our roadmap for today. We'll breeze through structural market shifts and risks, touch on the multipolarization of demand, highlight some regional investment opportunities, really dig into the profitability gap by facility type, and finally, wrap up with future investment strategies. Okay, starting off with structural market shifts and risks. So we have to first establish our new baseline of market risk, because the ground is literally shifting under our feet right now. The old assumptions about who is booking hotel rooms in Japan, they simply don't apply anymore. The glaring takeaway here is this massive 40.4% year-on-year drop in Chinese guest nights. Now, historically, Chinese tourism has been the absolute cornerstone of the Japanese inbound market, right? But seeing it drop to just 1.72 million guest nights is a stark reminder of the severe, unignorable risk of single demographic dependency. If your assets or operations were underwritten assuming this perpetual, unending flow from one primary nation, well, this number is a glaring red flag for your portfolio.
But you know, where there's risk, there's usually replacement. And the data brilliantly illustrates exactly how this replacement demand is playing out right now. To cover that massive shortfall, we're seeing just explosive growth from other regions. The US is up over 10%, crossing 1 million guest nights. Canada surged by nearly 50%. And get this, Vietnam absolutely skyrocketed by 103.4%. This multinational demand is stepping right in to stabilize revenue streams. Assets that have proactively pivoted to accommodate a much wider, more global customer base are seeing their operations stabilize beautifully.
Moving right along to Section 2, the multipolarization of inbound demand.
Beneath the surface, the internal attributes of all this accommodation demand are fundamentally changing. Looking at the big picture for February 2026, total guest nights actually shrank just a tiny bit, down 0.6% to 47.65 million. And that's primarily driven by domestic Japanese demand dropping a bit. But check out the foreign demand. It's growing at 2%, acting as this absolutely crucial counterbalance. In fact, this diverse wave of inbound tourists now makes up nearly 30% of all guest nights in Japan. They are effectively acting as a massive market risk mitigant for the entire sector. And in a really fascinating twist, Taiwan actually took the #1 spot for foreign guest nights, carving out over 19% of the total pie.
Which brings us to Section 3, investment opportunities out in the regions.
Look, institutional capital has to follow the tourists, and the tourists are expanding outward. If your capital is exclusively focused on central Tokyo, you are seriously missing the bigger story here. The old narrative of the Golden Route is evolving fast. The 3 major metropolitan areas actually saw a 1.7% decrease in foreign guest nights year on year. But in stark contrast, the regional areas outside those major metros grew by nearly 8%, and they now capture a massive 41.4% share of all foreign guest nights. So the verdict is in. Regional assets are no longer just a niche play. They are a major, highly viable alternative asset class.
And hey, it's not just international travelers dispersing out into the countryside. For investors hunting for emerging markets, you have to look at the staggering year-on-year domestic guest growth in these specific prefectures. Ibaraki is up over 34%, Yamaguchi nearly 30%, and Toyama over 27%. That is serious growth. This dual diversification, both domestic and international travelers pushing outward, is driving up accommodation demand well outside the traditional city centers. These are highly lucrative target zones for acquisition. Okay, let's pivot to Section 4. This is the big one, the profitability gap by facility type. This is where the rubber meets the road for your bottom line. We urgently need to highlight this exact profitability gap. While the national average occupancy is hovering around 60%, look at this stark, undeniable divergence. Highly scalable business and city hotels are operating at peak efficiency. We're talking 74% and almost 70% occupancy respectively. Conversely, traditional accommodations are facing severe market risk. Ryokans are sitting at just 40%, and simple accommodations are struggling at an abysmal 25%. The market is speaking incredibly loudly here. If you want high yields and low risk, high convenience private room formats are the only clear path forward.
And when you look at prime locations, the data gets even wilder. Business hotels in the Tokyo metropolis are recording over 83% occupancy. And down south in the major resort area of Okinawa, business hotels are showing an incredibly high 83.7%. What does this tell us? It proves, without a doubt, that operational efficiency paired with either a strong regional resort presence or a major transit hub yields absolute premium returns. It is the winning formula for high, stable yield. And it's not just us noticing this, the government is officially recognizing this shift too. Starting recently, the Japan Tourism Agency actually changed its stratification criteria. They shifted from measuring by the number of workers to the number of guest rooms. Why does that matter? Because this statistical shift officially recognizes that physical room capacity and operational efficiency are the true underlying drivers of modern profitability. Medium to large-scale facilities make it so much easier to disperse your fixed costs and maintain staff efficiency. Because of this, we're seeing investment funds rapidly ditching small-scale properties with low occupancy and pouring capital directly into scalable, medium to large hotel properties. So let's wrap this all up in Section 5, your future real estate investment strategy. Synthesizing all this structural data, investors face a very clear set of choices to secure long-term revenue. First, be incredibly careful with the major metros. Yes, demand is solid, but intense land competition and soaring construction costs will aggressively compress your yields. Instead, the smart money is deploying capital into scalable, medium to large facilities in those emerging regional hubs we just talked about, or systematically upgrading existing regional facilities. And above all else, you absolutely must diversify your property's demographic appeal. If your operation relies entirely on one specific customer segment, you are leaving yourself totally exposed to external shocks.
So as this structural shift in the market accelerates, and as that massive occupancy gap between high-performing business hotels and struggling traditional assets widens even further, I'll leave you with this one critical question. Is your real estate portfolio truly positioned to capture this new, dispersed, and multipolar wave of high-yield demand? The data couldn't be clearer. Efficiency, scale, and regional dispersion are your keys to the future. Thanks for joining me for this explainer, and I hope these insights help drive your next big acquisition strategy.